Hey everyone, it's Imran back with another macro options spotlight. Okay, what's going on? Investors really crowding back into tech over the last month, but certainly last week as well. B of A showed largest monthly inflows since February 2021. Massive inflows. We're talking about $15 billion over the month. Last week was also a record in terms of inflows. Saw close to 9 billion there. Investors really getting stopped into tech stocks. Obviously, they're trying to keep up with benchmarks. The AI boom has just got these mega caps flying, and people are struggling to keep up with the S&P and feeling that they have to get exposure. Now, the move definitely seems a bit overdone from my perspective in the near term. We have started to see some underperformance from the leader, NVIDIA, for a change. But, that's 1 or 2 days. So we'll see if that turns into something. But we did see a bit of a catch up from the unloved mid-cap space. So the Russell having a 3.5% rally on stronger labor market data on Friday. And that's, calling tops is very difficult, but we are not looking to chase the rally here, basically, right? We are looking for smart ways to maybe pick up some vol, but we're not really chasing the delta here. Another interesting data point, if we look at the charts, is this gross leverage from hedge funds. Steadily been rising. So you can see this orange line here has been going up since the start of the year, and basically is currently at the high since 2017. Net leverage, on the other hand, hasn't really done the same thing. So that does have room to climb, but the numbers do suggest that risk appetite, certainly from a gross perspective, has been rising. Now, remember that much of the short positioning that people talk about in S&P futures is coming from hedges that they put on against other longs they might have in their portfolios, whether they are other longs in futures like the NASDAQ or stock positions that they have, and they're just doing their macro beta hedging via S&P futures. So this does create a bit of a, this creates larger gross books when you have a stock portfolio that you then sell futures against. And it can give the illusion of extreme bearishness because you're short all these futures, but you have got underlying longs against it. So, we wouldn't be surprised if there was some sort of pause in markets over the summer, given how frothy things are, and we're just not sure that sentiment is extreme bearish as people maybe think it is. Okay, so that's just something to be aware of. All right, moving over to our dashboard, what we're seeing in the cross-asset vol space. You can see here, stocks obviously having a very strong day on Friday, closing out a strong week. Debt ceiling deal was passed. Goldilocks jobs data from non-farms was met with a strong rally, particularly in the mid-caps and cyclicals. Precious metals were softer, though, as real yields traded higher. But oil was relatively firm in commodities ahead of OPEC, who this weekend delivered more voluntary production cuts from the Saudis due to start in July. The dollar retreated from highs close to 105, but does still remain above 104 and is being supported by higher yields. Looking at skew, that's the big one, an absolute destruction of skew, down about 3 points on the 1 month 25 delta skew on S&P on the week. That's an enormous move, taking NASDAQ, S&P skew back down to pretty much the lows. So absolute free fall as that upside chase kicked into gear. Precious metals skew also popping, seeing a bit of green here. As the spot remains weak in precious metals, people are less optimistic of the breakout, it seems. And then nat gas skew also moving back up to a put premium, up 2 vols on the week as nat gas spot managed to fall about 10% on the week. Okay. HYG skew also standing out, getting hit another 80 basis points, taking it down to the lows, 0 percentile there. We did speak about that at the end of last week, that HYG vol and skew are getting what looks to us a bit oversold. Looking at implied vols, obviously getting hammered across equities as markets trading up, options getting sold, particularly downside options. VIX went to sub 15 levels, first time since November 21, as those front end index vols are approaching single digits now. Have not seen that in quite some time, and it's hard to want to sell them at those levels. You look at the carry, very, very deep red across all of the major indices, certainly outside of Asia. Japan's still in small green, but in general, really showing you there that realized vol is significantly higher than current implied vols. Looking at commodity vol, that was also hit on Friday, but we have seen a bit of a divergence between energy vols that were up about 4 points on the week and precious metals vols that are down about 2 points on the week as well. Copper vol hanging in there relatively unchanged at around 25. Bonds also smashed on the week, down 4 points on TLT. That's a pretty dramatic move in vol. It remains in positive carry, so it just shows you how little TLT is realizing on a relative basis. You look at HYG on the other hand, that vol is on a 6 handle. It's also very low. It's been realizing better though, providing negative carry now, and another reason why we're thinking HYG vol is probably better value. All right, that's our summary. If we look on to what else we're seeing, so we mentioned skew. So if we look at various measures of skew across the space, right, there was definitely a different kind of panic last week. Many had anticipated the debt ceiling D-Day would provide some sort of panic in markets, but instead it was a panic to sell protection as the deal got done and, not get left behind by this relentless rally that we're seeing across stocks. Some key measures, such as the SDEX, this is like a skew index that has been created, that falling off a cliff. Also, we look at the put-call ratio, same story, back down to 1-year lows. And these things have typically coincided with tops in the market. You can see in this chart here, S&P topped out in August when this ratio was down near the lows. It did it again in around sort of February time. And now, once again, we are seeing the put-call ratio back down to these levels. We haven't seen the market turn yet, but it could well easily do that. Okay, and then obviously our 1 month 25 delta skew on our dashboards, that is at its lows as well. Now, so apart from the removal of tail risk, which is obviously the US default risk that you could argue that is being priced out of the market, we see another good reason why skew is moving and not something everyone's talking about. And this is about gamma positioning. So if we look at the Goldman's options guys, they put out some dealer gamma positioning recently. And it often looks quite different to the gamma positioning that we see on some of those other models out there, okay? Because they make various assumptions about dealers being long or short various strikes. And because they don't necessarily see all the flows, like the big OTC flows in the market, which Goldman's clearly do see, those models don't take into account some very, very important factors. And the idea being is that most of those models consider that gamma is long. Maybe it reaches a peak, but it's long on the upside. So as the market keeps going, they would anticipate that the street remains pretty long gamma on the upside, basically, right? Because they see all those upsides as dealers being long. What they don't see is when clients who are concerned about the upside melt-up risk, when they buy a load of low delta upside calls, that flips the dealers short on the upside. And that's when we get this situation where the dealers 3% higher than the market could suddenly flip very, very short. So right now, Goldman's estimate at 43.50 on the S&P, dealers are actually flat gamma, and above that, they get short about $1 billion of gamma, which is quite interesting because that is in contradiction with what the other models out there would think. So that would actually explain why in the rally last week, you are seeing upside vol not actually as well offered as downside vol. Because if dealers know that they're going to run out of inventory if the market rallies, they're going to be more comfortable selling downside options than they are selling upside options. And where do we see that? We look at our fixed strike vol monitor to see where the dealers are actually playing and what options they're more comfortable buying or selling. Okay, so you can see here, this is something we screen every week. We put it in our weekly report. I threw it in for today's daily, and we can see that downside options in July, downside options in June were down a lot more than what the options were on the upside. Okay, you can also see that here, 41.50 is where the bulk of the pain was in June options, and then anything above 4,400 was flat to up, basically. Okay, so that's showing us that these vols on the upside that are on a 10 handle basically are looking too cheap, and dealers aren't happy to sell them anymore, which suggests that dealers are going to run out of gamma inventory with the market a few percent higher. So that is being confirmed by what we're seeing in moves in the fixed strike surface. And therefore, we need to be aware of that, because generally people think there's going to be a big wall of resistance at 43, 43.50. Okay, we're not going to be able to break through. However, if this is true, then that wall of resistance could evaporate pretty damn fast, and we may see more chasing to the upside, and we may see this vol up, spot up dynamic that we've talked about before. and that's very possible. And that may ultimately lead to a local top in the market, but we just don't think we're quite there yet. We'd like to see that crescendo. We'd like to see us squeeze through those areas and get dealers being forced to buy gamma up there. And that is your signal, okay, that this thing has got a little bit too far gone, and the market could find a local top. We get the suspicion that we're not quite ready for the market to roll over just yet. Okay. Anyway, that's what we're seeing. Skew's getting hammered. What can we do about it? So clearly, our strategy compass on the S&P is going to be in buy puts, because spot is high and vol is low. So blindly, if you're just following that as a mean reversion guy, you'd be like, okay, I'm buying puts here because they're battered. You look at skew's fallen off a cliff. It's also falling on a 90-day basis, right? Not just a 30-day basis, but 90-day basis coming down as well. Not quite as dramatically. So really it is the front end that has collapsed. You look at front end vol, that's also collapsed into steep contango. So clearly the value in the curve is front end downside, right? That stuff's trading as cheap as it's been trading in a long time. Volatility carry is very negative on S&P, suggesting that owning some optionality doesn't look ridiculous. So these are the things that we're seeing. But because of the melt up risk that we talked about, we would be concerned to just buy puts and be short a load of delta in this market right now. All right, catch you tomorrow. Cheers.